All right, Monday market update. I am Matt Gouget, Matt the Mortgage Guy. I've got Nash Paradise, the Loan Wizard, and we've got action. We had some movement and some exciting stuff happen last week. Nash is going to talk to us about what we're looking at this week and into the future. Everything mortgage related, rate related, economy related, and how that all ties into to real estate. What do you think, Nash?
Yeah, man, it's fun to be with you here this Monday morning, every Monday morning. Sometimes we got a ton to talk about, lots of exciting stuff. Sometimes we get to recap a little bit of nothing. That's kind of where we are right now. I don't mind a slow news day. A quick MMU is a good time. We can all get on with our lives and on with helping homeowners. So let's dive right into last week. Now, if you remember last week's Monday Market Update, man, we had multiple sheets here. Here, there's really just one thing popping out. And now if I was to talk to someone on the street and be like, hey, ISM in MFG PMI, I'm like, could you get more letters to describe what something is here? I'm not sure that you could. This is the Institute for Supply Management, ISM, in MFG, non-manufacturing global services PMI. This is basically the non-manufacturing sector. So non-manufacturing. Are businesses growing? Are they expanding? Are they shrinking? Anything over 50 is expanding. Anything under 50 is shrinking. And the closer you are to 50, closer it is. So looking at this is the only news last week that mattered. Forecast was that, we'd be growing a little bit more, non-manufacturing, expanding a bit more. It was a tad soft, and that is well in line with what we got the week before. Just to recap a little bit on that, we missed big on jobs. I mean, real big. The economy has not added nearly as many jobs in the last 90 days as we thought. Revisions came out, kind of crushed everything. So we're starting to see things slow down a little bit. And so after we got a really nice improvement to interest rates Friday before last week just kind of held the line. It said all the econ data aligns with what happened the week before. We're a little soft on this non-manufacturing data. Everything else was pretty in line. Initial jobless claims, sometimes we care more or less about that. Wasn't huge news. Came in very close to estimates. And so last week was pretty much just chalk. We did lose a little bit on interest rates as the week went on, but it didn't have anything to do with the econ data. It had a lot to do with what's going on this week. So let's talk about this week because everyone is bracing for Tuesday. There isn't even anything on Monday. No news today. Nothing interesting happening today. Everything's going on tomorrow. And tomorrow is big. Tomorrow is CPI. CPI is inflation. We've got our month over month and our year over year. And we are expecting this to go up. So we're looking at month over month core CPI to go from 0.2 to 0.3 on the forecast, year over year from 2.9 to 3.0. Rounding is going to play a factor here. Rounding is going to be important. In my opinion, it's kind of what I'm thinking happened. If we roll up at, year over year inflation at, 3.01, 3.04, cool. Rounding down to 3.0, it's going to be all right. Still going to make headlines going from a sub 3% core inflation rate to 3%. But I think it's the month over month, which is going to be a pretty big driver. Our last month over month PMI, CPI, and PPI data were all heavily impacted by the rounding. So we were at 0.2. Now we're forecasting 0.3. If we can come in close to that, everything will hold. This is a recipe for big misses, though. If we come in just a little high on the month to month, 0.34, 0.35, and that gets rounded up, it's not going to be ideal. We definitely want to make sure we hit that on the mark. And, this is that spot in the MMU where we say, hey, lock it if you like it, because tomorrow there's a chance that things could toe the line and keep going with where we have been. We come up a little short, but with the slowdown in the economy and with all the tariff stuff coming down, if we have an economy slowing and rising inflation, that's going to be really bad for the bond market. If everything's all right, then, we're going to hold steady, but I don't expect anything that moves the market a significant improvement tomorrow.
Yeah, I think you're right. What do you see? Because I know when I looked at this in the, past months, like the year over year numbers it's almost impossible for those to go down, given like the lower summer readings for
Mm-hmm.
last year. So like if you were a betting man, which it sounds like you're leaning this way, like missing to the upside is way more likely than it coming in lower than expected, right?
Yeah. Let's call it 80-20 on
Yeah.
the percentages there. I think if we're gonna miss high. I'd love to be wrong, but I mean, you look at the last few year-over-year readings, and they're going up throughout the summer. It's really, really hard based on like you said, based on where last summer's readings were a year ago, to come in short of that. So I think, and once you cross that 3% threshold, it just sounds a lot worse. In February we came in at 3.1%, which is kind of rough. Everyone was bracing for February because we knew we were replacing some really low numbers there, and we just moved up throughout the summer. April, May, June, 2.8, 2.8, 2.9. We're trending up because of what we're replacing here on the core CPI. And yeah, I think if we miss, we're going to miss a little high. I'd love to miss low. Missing low would be pretty cool, but I don't think it's going to happen.
Not as likely. Yeah. Agreed.
Mm-mm.
Agreed.
All right. So that's the big stuff this week. End of the week, nothing matters more than Tuesday. So let's move on to the fun stuff here. This has been interesting. In fact, I just updated this sheet in my system because, I've got, if you see my eyes popping around, I got like 5 screens up here. I look like a day trader, which doesn't make sense because I just write mortgages, but I like seeing all this stuff in real time. And this is adjusted slightly. This is telling us where we expect the Fed funds rate to go. And I think it is a foregone conclusion that in September, we're going to see the first Fed rate drop of the year. Can you believe we're waiting until September for that? I don't. What this is showing is Fed drop 2 in October. My system right here says not dropping in October. It's been close. This is 50.5 versus 49 to no drop in October. Mine's 48.5 to 51.5. So I mean we're teeter-tottering here on that. Do we get a drop in October or not? I think going back to back in drops will help kind of shape the direction that the economy is moving, because those drops aren't going to have an instant impact on really anything. But I feel like we've been on this precipice of waiting for these drops, waiting to get some consistency in lowering the Fed funds rate so other things will start to follow suit. And I think going back to back would be really helpful for that. Right now, the likelihood of it is, a coin flip.
It's even better than back to back. Just
3 in a row.
Double in September. And this was going to be my fun. Like, let's just for the sake of having a little bit of fun, throw out some wild scenarios. And I'll structure it like this as a question to pose to the Lone Wizard.
Yeah, boss.
What would need to happen, namely with call it tomorrow's CPI report, for the Fed to say, oh my gosh, jobs came in, way lower than expected. Wow, CPI is this number. What would have to happen in your mind for them to start leaning towards and it be a real possibility that we go 50 basis points in September?
Probably 30 basis points on the year over year. We need to come in at like 2.7 instead of 3%.
Okay.
I think it needs to be that severe. The month over month is a lot more difficult because it just shows 0.2% to 0.3%, but that doesn't really tell the story. It's the rounding is a lot more important. So if you go from, instead of the 0.3% forecast, we come in at like 0.23, 0.24, something that rounds down to 0.2, but by a significant block, even as low as like 0.19, 0.18, something that still rounds to 0.2, but is a lot further away, then I think you're going to see the needle move. I don't think it's going to move enough to actually cause a double drop here in September. I mean, the chances right now of a 2 drop September is goose egg, 0.0%. And we are, a little more than a month out from that. The fact that it's a 0% probability, could we see that shift in that 13.6% no movement move to the other side? It's possible. It's going to take something pretty severe right now to make that happen.
Yeah, fun to think about. All right, let's
it
look
is.
at rates.
But people know more than we do, and the people that know more than we do are the ones moving a lot of money around. They've got billions of dollars in play. And just looking at where the 10-year Treasury bond yields have been chilling, I say chilling, they're not really chilling since they hit their low spot on August 4th, which, I mean, that's what, a good bit of time away from now, a good solid week. We went up all last week and settled from that 10-year at 4.194. So like that 4.2 mark has been a really hard floor for the 10-year Treasury yields to break through. Got all the way up to 4.28. Right now we're at 4.27. We do not, for whatever reason, want to break through that 4.2 floor. And then we're going to get another, when we finally do, we'll get another floor at 4.0%. So I feel like the bond traders know what's coming based on the previous econ data. It's going to take core CPI, the jobless claims at the end of the week. We need to really look like not only are we adding fewer jobs than we thought, because, I mean, that's what those revisions showed, but that we also have, a significant number of the population looking for work, and that continued claims are going up. Like if unemployment starts to shoot up, we're going to see a lot more likely movement. But the jobs report has been holding the Fed steady based on their dual mandate, even though inflation has been coming down to a level that the Fed funds rate really does not need to be this high to try to maintain 2.8, 2.9 inflation.
Cool.
A lot of numbers, a lot of fun stuff. I'll let you talk about the ultra fun stuff, though. Give me what we're looking at here on mortgage rates.
Ooh, look at mortgage rates. Look at that green line.
Green, bro, that's blue.
Or that's what I meant.
Green.
Blue. I'm sorry.
I just figured you had a funny hue going on with your monitor there.
No, I'm just getting older. I'm getting older, and either blind or forgetful or both. Just ask my wife. I can't hear. I can't see. I'm forgetting things.
You're too young for that, but what do you see?
What I do see is that 6.75 to 7% range that we seem to be kind of stuck in all of 2025. We broke out of. And so rates have come down. I don't know the official number on this Mortgage News Daily chart.
657.
657. So we're below 6.6. And again, this is 30-year fixed rate, probably 25% down, probably throwing a point in cost at getting it there. So not like everybody's just going to go sign up for a 30-year fix and that's what everybody gets. But still, we see the trajectory and we see the big move that, that big miss in jobs had a big effect on mortgage rates, almost to the tune of like 0.25% in rate, which somebody buying a $500,000 house and financing 400,000 of it, 0.25% in rate is a big deal. It's going to save them a few $100 a month. And so, in my mind, like it's not like it's moving millions of people off of the sidelines, but some people that might have been on the fence are like, oh, you know what? I'm going to go out and buy something. And, there's just endless data that will show people demand and mortgage rates / affordability are kind of interlinked. And so as mortgage rates come down, demand comes back into the housing market. And, it's probably good in a lot of markets for some demand to come back because there's a lot of inventory stacking up and there's been a little bit of imbalance in some markets. So it'll be interesting to see how this continues to play out. Like you said, we need to break some resistance barriers in the 10-year to really get rates to come down significantly. But there's a chance that we do, and there's a chance that has a real effect on demand, which will have a real effect on real estate, dynamics between buyers and sellers.
What's funny about it though, Matt, is so I was reading something this morning. I was looking and digging a little deeper into these numbers. I was like, 657, that sounds a little lower than what I'm seeing. We're mortgage brokers, so we can send our stuff to dozens and dozens of lenders. We see rates across the board. And I also looked at another article and I saw mortgage applications shot up about 10% since August 4th because, these rates have dropped. And there's something I touched on last week, and I'm going to touch on it again right now. We are emotional salespeople in real estate, mortgage, insurance, like anyone that is around the real estate dynamic. We are highly emotional. Maybe we're emotionally fragile. I don't know. We get excited. We get overly excited. The highs are too high. The lows are too low. And so we get this drop in the 10-year Treasury. We get this improvement in mortgage bonds. and people start going hard. And okay, so mortgage applications went up a whole lot. But what I noticed is what you normally see in Mortgage News Daily is now a significant amount under the updated Freddie Mac and the MBA composite index for overnight average rates. That tells me people are paying more. So then I go and look, I'm like, yeah, people are paying more. Looking at how these interest rates are pricing across the different coupons, lenders have gotten excited and they're wanting to offer something that sounds better. 6.5 sounds better. 6.6 sounds a lot better than the way that they've been pricing stuff at 6.99, 7.1, whatever. And yeah, it's just a little bit more money now to get that 6.6, which is funny because we're emotional salespeople, and we are responding to that emotion by making recommendations that involve a little bit more in discount points. They involve buying down a little bit more. My caution on this is do the math. The math will always tell you what makes the most sense. We are in a market where over the next couple of years, interest rates will decline. How quickly to how far, no one knows for sure, but all the econ data, everything that we've been dealing with the last 3+ years say we're going down. I think that's a foregone conclusion that most people will agree on. In an environment where interest rates are dropping, paying a lot extra to have something that feels good, sounds good, isn't necessarily good. So my call to action here is for the real estate and mortgage professionals in the room. Do the math. Make sure that you're doing the right thing for people. Yeah, that 6.6 may be cool because you didn't have it 2 weeks ago, and it sounds a lot better. And yeah, $120 savings a month is great, but at what cost? Sometimes putting that person in a 6.99, that's $5,000 or $6,000 cheaper when you do the math out of it. That higher interest rate, one, it's easier to refinance in the future, so you leave yourself a little bit more room. And, the cost benefit threshold between those two rates could be 4 or 5 years. Knowing what we know as professionals and as experts and as people watching the market, this is not marry the house, date the rate. I hate that crap. This is using math to make the most logical decision based on someone's short-term and long-term needs. So ask the right questions, understand how long they're going to be in the property, know what the long-term goals are, and then be that trusted expert to explain why one option may make more sense than the other. I get using interest rates to get people on the phone. They're dropping. Cool. Let's talk about what this looks like. But when you've got a captive audience, be the professional who uses the numbers, uses the math to help people in the best spot.
I agree 1000%. As you said, like if you ask your loan officer, what's the break-even analysis, and they don't know the answer to that, they don't know what you're talking about, you probably need to find someone who does know, because all of us who understand math at a high level, and really it's not complicated math, but it's just like, if you spend an extra $4,800 to save $48 a month, you better be in this thing for over 100 months, or else that was not a good decision based on the break-even analysis. One thing I do want to say too, and just get it out there, because I've had a lot of people on the fence with refinance. So this is another public service announcement brought to you by Matt the Mortgage Guy and Nash Paradise the Lone Wizard.
Don't put my name on this one. I got to hear what you say first.
People, when presented with a refinance scenario that makes sense, where the break-even analysis makes sense, are waiting because as consumers, as human beings, we always think things are going to get better. And so I present somebody with going from 7.25 to 6.25 saves you $250 a month. That's great. And I show them, here's the cost. It's going to break even within 19 months. This is something I would personally do if I was you. No, I want to wait. Well, what happens, and I've seen it happen because I've done this for 12 years and I've worked with thousands of clients. You wait 6 months, 9 months, turns into 12 months. Now you've paid an extra $250 in interest for 12 months. That's $3,000. But you're waiting paid off. Now you can get a 5.99%. The only problem is that 5.99% is only $38 cheaper than the 6.25 we tried to do 1 year ago, but you wanted to wait. Now, how many $38 per month is it going to take in extra savings to make up for the extra $3,000 you paid, right? That's like almost a reverse break-even analysis on the cost of waiting to do a refinance that makes sense today. So make sure that, like, even if you don't understand it like on your own, you have a loan professional that can talk you through the numbers and say, here's why I think it makes sense. Here's the break-even analysis. Here's the math. Because to your point, Nash, math doesn't lie.
No, that's a great closing. You can go ahead and put my name on that 100% because I'm with you. The cost of waiting is real. We need to be looking at the cost of everything. Be sure to get back here next Monday morning, 10:30 a.m. Central Standard Time, because we're going to be talking about what happened, and you're going to want to know what to say, how to have these conversations, because I have a feeling that after this week's core CPI, we're going to be trending in a direction where we have a lot more knowledge and a lot more availability to look forward and see what's coming through the rest of the year, even into first quarter of next year. Finally, getting some of this tariff stuff in the rearview mirror so we know what to expect. And, it's going to make the MMU a lot more fun here going forward.
Sweet. Looking forward to it, man. Have a good week.
Take care.